Listen up. My name is Robert, and if you were asleep 6 hours ago, you missed it. You missed the moment the silver market fundamentally broke in half. Not a correction, not a rally, a break. While the West was sleeping, the East just printed $100 per ounce on physical silver. And the financial media, your CNBCS, your Bloombergs, they're calling it a localized anomaly. A glitch. They're hoping you'll scroll past it and go back to checking your retirement account like nothing happened. But I've been staring at these screens since 3 a.m., and I'm telling you right now, the screens you're looking at in New York and London are lying to you. This isn't about a price move. This is about a total regional decoupling. And it happened overnight while most of America was asleep. History was made, the kind of history that doesn't get a headline until it's already too late to position for it. I'm not a YouTuber. I'm a private commodities analyst who has spent the last 12 years trading physical metals and monitoring vault flows that most retail investors will never see. I built this channel using an AI avatar for one reason: speed. Because I got tired of waiting half a day for the mainstream news to report what I was already seeing in real time on my terminal. And frankly, I got tired of watching all these new AI-generated channels pump out fake hype and garbage speculation about silver when there are real people out there, stackers, holders, retail investors like you, who need actual information, not clickbait. The Shanghai $100 print. What actually happened? So here's the reality. The $100 print in Shanghai, that's just the smoke. The fire is what's happening to the Western vaults right now, and it's moving faster than anyone predicted. Physical metal is bleeding out of the COMEX and the LBMA at a rate that should terrify anyone holding paper contracts. And the arbitrage gap, the price difference between East and West, just hit $13.89. That's not a spread. That's a chasm. That's a market that has lost structural integrity. Let me be very clear about what I'm claiming here, because this isn't standard bull market talk. This isn't me telling you silver's going up because of some chart pattern or some Fed policy. What we are witnessing right now is a structural price reset, not a rally, a reset. There's a massive arbitrage gap forming between Eastern and Western exchanges, and that gap is forcing a physical drain that the paper market simply cannot stop. They can print contracts all day long. They cannot print bars of silver. And here's the part that should make you sit up. Gold has been in a 77-day rising channel, grinding higher with discipline and patience. But as of a few hours ago, silver has become the lead dog. It outperformed gold by nearly 4 times overnight. 4 times. When silver starts outperforming gold at that ratio, you're not in a normal market anymore. You're in the parabolic phase. The phase where things move so fast that by the time the talking heads on television figure out what's happening, the opportunity is already gone. The numbers that locked in at 3 a.m., let's start with the hard data. The snapshot I pulled a few hours ago. Gold spot price, $2,624.39. It's testing the upper boundary of that 77-day rising channel I mentioned. Steady, disciplined, exactly where it should be if this were a normal precious metals bull run. Silver spot price, $89.88, up 2.34% while the world slept. That's the New York price. That's the London price. That's the price you see when you check Kitco or any of the standard Western data feeds. But here's where it gets interesting. Shanghai silver, the price being paid for physical delivery in the East, is trading at $103.77. Let me say that again. In New York, you can buy silver for under $90. In Shanghai, you cannot touch it for less than $103. This is a market that has been broken in half. The discount currently available in Western markets is $13.89 per ounce. Think about what that means. If you can secure physical silver in New York at $89 and ship it to Shanghai where it's trading at $103, you just made a $13 arbitrage profit per ounce. Minus shipping, minus insurance, minus the headache of international logistics, you're still clearing $8 to $10 per ounce on a pure arbitrage play. That is free money, and when free money appears in the markets, smart money moves fast, the gold to silver ratio collapses. Now stop. I want you to look at the gold to silver ratio with me for a second. It's sitting at 51.4 right now. For those who don't track this metric, the ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, that number has bounced between 50 and 80 over the last 2 decades. When it's high, like 80 or 90, silver is cheap relative to gold. When it's low, like 40 or 30, silver is expensive relative to gold. Right now, we're at 51, which is middle territory, but the momentum is vertical. The ratio is collapsing, and collapsing fast. Here's the leader-lagger dynamic you need to understand. Gold moved up 0.6% overnight. Silver moved up 2.34%. That's a 4-to-1 outperformance ratio. When silver starts moving 4 times faster than gold, You have officially entered the parabolic phase of the precious metal cycle. This is the phase where retail investors wake up, check their phones, and realize they missed the entry point by 3 weeks. This is the phase where the smart money is already positioned and is now just watching the chaos unfold. Why the COMEX is bleeding out. Let's talk about arbitrage dislocation, because this is the mechanism that's driving everything right now. If you don't understand this, you won't understand why the $100 Shanghai print is so significant. Arbitrage is the act of buying low in one market and selling high in another market simultaneously. It's one of the oldest tricks in finance. Buy apples for $2 in town A, sell them for $3 in town B, pocket the $1 difference. Simple. A dislocation happens when that gap becomes so large that physical supply begins to bleed out of the cheaper market and flow into the more expensive one. It's not just a number on a screen at that point. It's actual movement of physical goods, bars of silver being loaded onto planes and ships and moved across oceans. That's what we're seeing right now. Here's the analogy I want you to think about. Imagine 2 gas stations on opposite sides of the street. Station A is selling gasoline for $3 per gallon. Station B is selling gasoline for $4.50 per gallon. What happens? Everyone lines up at Station A. They fill up. They fill jerry cans. They fill every container they can find. And they keep doing it until Station A runs dry. Then Station A has 2 choices: close the doors or raise the price to match Station B. There's no third option. The COMEX and the LBMA, the 2 big Western exchanges for precious metals, they are Station A right now. They are selling silver for $89 while the East is paying $103, and smart money is lining up. They are buying every available ounce at $89 and shipping it east to sell at $103. This isn't theoretical. This is happening. I've seen the vault drawdown reports. Registered silver at the COMEX has been bleeding for weeks, and it just accelerated. The math that terrifies Wall Street. Let's run the numbers. Conservative scenario first. If the gold to silver ratio simply stays where it is right now, around 51, and gold maintains its current channel at $2,624, then silver's fair value is already at the $90 mark we're seeing in the West. That's the baseline. That's the nothing crazy happens scenario. But let's stress test it. Let's run the math based on the targets I've been seeing from analysts I actually respect. If the ratio moves to 40 and gold stays at $2,624, you divide that by 40 and you get $115.60 per ounce for silver. Instantly. No additional move in gold required. Just the ratio compression alone gets you to $115. Now let's talk about the reset scenario. If silver simply resets to the Shanghai price of $103.77, if the West just catches up to where the East already is, the gold to silver ratio drops to 44. We're already halfway there. The gap is closing, whether the Western exchanges want it to or not. And this is where the $13.89 bomb comes in. That's the amount of pressure currently pushing against the Western price ceiling. Every hour that gap stays open, more metal drains east. Every day the COMEX refuses to let the price rise to meet Shanghai, they lose more registered inventory. They are bleeding out, and they know it. What I'm watching right now, here are the specific indicators I'm monitoring on my dashboard. First, the $91 breakout. If New York opens today and pushes past $91, the catch-up is official. That's the signal that Western markets are acknowledging the Shanghai premium and are starting to close the gap. If we clear $91, we're going to $95 fast, then $100, then $110. Second, the gold to silver ratio at 48. Right now we're at 51. If we cross under 50 and hit 48, the decoupling is permanent. That's the point of no return. That's when even the skeptics will have to admit that something fundamental has changed in the market structure. Third, gold's 77-day channel. Look at that channel. It's a beautiful rising channel, clean, predictable. If we break the top of that channel, if gold pushes above $2,700, there's no historical resistance until we hit the reset levels. We're talking $2,000 to $900, $3,000. And if gold is running free above the channel, silver is going to go parabolic. The ratio will compress to 40 or below, and we're looking at $130 silver within weeks. My personal battle plan. What am I doing with my own silver right now? I want to be very clear about something. I'm not here to tell you what to do. I don't know your financial situation. I don't know your risk tolerance. But I can tell you what I am doing with my own money, and you can decide if any of it makes sense for your situation. I'm monitoring 2 specific triggers right now. Trigger A. If silver clears $91 in the New York session today, I'm interpreting that as the start of the Shanghai catch-up. At that point, I'll be looking to increase my exposure to physical-backed vehicles. Not paper, not futures. Physical-backed. That means allocated storage programs. That means ETFs that actually hold metal in vaults. That means if if I can find it at a reasonable premium, physical bars and coins. I'm not touching paper contracts in this environment because I do not trust the exchanges to honor delivery if this thing goes sideways. Trigger B, if the gold to silver ratio hits 40 as predicted by the analysts I follow, I will personally consider rebalancing. Here's what that means. If silver outperforms gold to the point where the ratio hits 40, I will take some of my silver reset profits and rotate them back into gold to lock in that outperformance. Why? Because at 40, silver might be overbought relative to gold. The ratio could snap back to 45 or 50, and I don't want to ride that roller coaster. The elephant in the room. Let's talk about the thing nobody wants to say out loud, but everyone is thinking, what if the exchanges just cheat? What if the COMEX and the LBMA see this arbitrage pressure building, see the registered inventory draining, and they just change the rules? What if they suspend delivery? What if they force cash settlement? It's a legitimate concern, and the answer is they probably will. History says they will. When the exchanges feel existential pressure, they change the rules. They've done it before. They'll do it again. But here's my take on that. Changing the rules works when the pressure is speculative. If this were just a bunch of hedge funds piling into futures contracts with no intention of taking delivery, then yeah, a margin hike or a rule change would crush the rally overnight. But this isn't purely speculative pressure. This is arbitrage pressure. This is physical metal moving from west to east because there's a $13 profit to be made. You can change the COMEX rules all you want. You can't change the fact that someone in Shanghai is willing to pay $103 for silver while someone in New York is selling it for $89. That gap will persist until one of two things happens. Either the Western price rises or the Western vaults run dry. The final word. The data is the data. The Shanghai premium is real. The arbitrage is real. The physical drain is real. The gold to silver ratio is collapsing in real time. All of that is factual. What's not factual is where this goes from here. I can run the math. I can show you the historical patterns. I can tell you what I think is likely, but I can't tell you what will happen. Nobody can. Markets are chaotic systems. Anything can happen. So take the information, do your own research, make your own decisions, and whatever you decide, do it with conviction. Don't half-ass this. Either you believe the thesis and you position for it, or you don't and you stay on the sidelines. There's no middle ground in a market that's moving this fast. Watch the $91 level, watch the gold to silver ratio, watch the registered inventory at the COMEX, and most importantly, watch gold's 77-day rising channel. Because if gold breaks, everything breaks. But if gold holds, we're going to $130. And that's not hype. That's just math. The screen is lying, the vaults don't lie, and the vaults are emptying. That's it. That's the video. If you made it this far, you're serious about this. Subscribe if you want more real-time data. Hit the bell if you want to catch these updates before the New York Open. And leave a comment telling me what you're seeing in your local market. Are premiums spiking? Are dealers running low on inventory? I want to know. Stay sharp.